Senator Ossoff, on behalf of the chair.
Thank you, Senator Tillis. Mr. Chairman, welcome back. Let me state at the outset, you have an extraordinarily challenging job in extraordinarily complex times, and much of what you are responding to and adapting to is beyond your control. Your success is the country's success to a significant extent. It's the world's success, and I fervently hope for your success and appreciate your continued efforts. I'd like to ask you to specify, if you can, what transmission mechanisms you believe are most sensitive right now to the change in monetary policy, what forms of consumption you expect to be most sensitive to it, and the extent to which you anticipate that some of the effects that you hope to have on aggregate demand through the increase in rates are transmitted via financial markets, and if so, how?
So I guess I would say three basic channels through which our tools work. The first would be interest-sensitive spending. So that's durables, including cars and things like that, durable goods, housing, for example. So when rates go up, spending on those purchases, which tend to be financed with debt, will be restrained. That's one major channel. The second is just asset prices generally across the economy. When interest rates go up, it raises the cost of holding assets. It can cause assets, again, broadly across the economy to either moderate their growth or decline somewhat in value, and that has an effect on, a broad effect across the economy on spending on everything. The third channel is really the exchange rate, which you can think of as another asset price, but that also has the effect of pressing down on inflation. So we look at all of those. Starting with the first one, you can see we just talked about the housing market. The housing market is the classic part of the economy that's very sensitive to interest rates, and you're going to see a moderation in housing demand. You're going to see declining, or slower increases at least, in housing prices. So those are the three main channels I would point to.
Let me ask about in terms of asset prices and how financial markets are responding to the Fed's stance. I've consistently asked you and Secretary Yellen, when you appear before the committee, to talk about systemic risks, risk to financial stability, risk of financial contagion. Where you're moving swiftly and markets are volatile, there are perhaps institutional trades that could rapidly unwind or exotic financial instruments that no longer function well. What do you anticipate to be the parts of capital markets now, or the phenomena in capital markets, that present the greatest risk to financial stability as the Fed takes the aggressive action that you're taking?
Well, I'd start by saying that the banking system is very strong, well-capitalized, highly liquid, does a much better job of understanding the risks it runs and managing them than before the global financial crisis. And that's a reflection of the work that regulators did and that the banks did too. So that part of the financial system is critically very strong, and we saw that through the pandemic, and we see it now. To your point, though, capital markets did show real periods of illiquidity during the immediate aftermath of the pandemic. And so we've been looking at ways, I say broadly, the regulatory community has been looking at ways to address that.
So you remain concerned about money markets?
Well, that's a different, so money markets that's a part of the economy which, where it has become illiquid because the assets that they were invested in were not able to be turned into cash quickly to fund depositors wanting to take their money back. So we stepped in and had to provide that liquidity for the second time. There are reforms going on there at the SEC which should address that, and they're in the process of being considered and then implemented. So that should help on that front. I was thinking more of the Treasury market, for example, which it became illiquid at the very beginning, when people wanted nothing but cash, nothing but the cash and most cash-like things. Treasury market has been functioning, though, all through this period when we've very significantly changed the stance of monetary policy. So markets have been functioning well, reasonably well, and
okay, my time's running short, and appreciate that. We'll probably follow up to talk a little bit more about financial risk. With my remaining few seconds, let me ask you this: how would you characterize the share of responsibility, if you will, on the supply side versus the demand side for the elevated price levels over the last year. To what extent do you believe that, you mentioned the supply curve being steeper than expected, and so the increased durable goods demand and consumer demand having a greater than expected effect on prices. Right now, is the principal driver of the increase in the price level elevated consumer demand, elevated demand, or is it supply constraints? I know we're facing both, but I'm asking you to allocate, as you can, some share to each phenomenon.
Yeah, I just would say it's clearly both factors are principally at work here. You couldn't get this kind of high inflation without strong demand, and you certainly couldn't get it without the kind of supply issues that we've had, both in the labor market reflected in high wages, and then in the goods market reflected in what's happened with durable goods. And cars in particular, you look there, it's been driven by semiconductor shortage.
Thank you, Chair Powell. Thank you, Mr.